Welcome to the deep dive. Okay, today we're cutting through the noise. We've got the top 10 global news stories from the last 12 hours or so. This is July 1st, 2025. Our mission really is to pull out the key nuggets, connect some dots, and give you the bigger picture fast. So I guess the opening question is, what's the world's economic pulse actually look like right now? How optimistic should we, really be?
It's so important to break these shifts down, understanding what's driving things right now and the sort of subtle undercurrents. Well, it gives you a crucial edge, especially when market sentiment can just pivot so quickly.
Absolutely. And speaking of pivots, we are seeing some, well, green shoots, I suppose, in global markets. Asian equities climbed, European shares nudged up a bit. What's really behind this? What's the main driver here?
What's fascinating is just how fast sentiment can shift based on diplomatic progress. Global risk appetite, it's definitely improved.
Right.
That's boosting global futures, the mega cap stocks, those huge companies that often set the tone. A big part of that is, I think, calmer geopolitical conditions, particularly some easing tensions in the Middle East. It's just a powerful reminder, isn't it, how linked global diplomacy and the financial markets really are.
Yeah, definitely. But okay, underneath this sort of wave of optimism, there's a really interesting, maybe slightly confusing picture when we drill down into energy. Brent crude oil prices, they're holding steady around $67.65.
This is stable.
Yes, stable. Again, tied to those receding Middle East risks and expected OPEC plus supply cuts. Now, that sounds pretty positive for the energy sector, right?
I think so.
Exactly. Yet, almost paradoxically, hedge funds, they're dumping energy sector shares, like at the fastest rate we've seen since late 2024.
Yeah, and that's not just a simple disconnect. It feels more like a critical early warning, perhaps.
Right.
When you see the smart money getting out of a sector while prices look okay on the surface,
Right.
it signals they're anticipating something else. It's that kind of smart money paradox. The obvious thing isn't always the profitable play. So it really raises the question, are these big players betting on, I don't know, a longer-term energy transition? Or maybe a demand shock that isn't fully priced in yet?
Interesting. It suggests they might see something coming that the rest of the market hasn't quite caught on to.
Precisely.
Okay, let's bring this discussion closer to home now. Look at the U.S. economy. Because we're seeing some pretty mixed signals there, too. On the one hand, you've got major American banks doing really well, surging after passing the Federal Reserve stress tests. And for you listening, this means these annual financial health checks, they're basically the Fed's stamp of approval. It signals stability, clears the path for dividend payouts. That's a huge vote of confidence, right, for shareholders, for the whole system.
Oh, absolutely. It is. And this is this confidence is sort of being tempered by these underlying concerns, worries over the U.S. fiscal and monetary direction.
Okay.
If we connect this to the bigger picture, you look at something like Trump's proposed $3.3 trillion fiscal plan. Well, analysts are raising flags about debt levels, how that might strain U.S. Treasury markets.
Right, debt concerns.
Exactly, and that uncertainty, it's already hitting currency markets. I mean, the U.S. dollar is actually getting close to a 4-year low against the euro and the yen. There's growing speculation about upcoming interest rate cuts.
Wow.
Yeah, it really shows how global confidence, or lack thereof, in a country's economic policy directly impacts its currency.
And you can actually see investors reacting to that policy uncertainty, can't you? Some are moving towards what they see as, well, more politically stable European markets.
That's the narrative emerging, yes, a shift towards perceived stability.
Okay, before we wrap up, there's one more really fascinating outlier I wanted to touch on briefly. It highlights just how complex capital flows can be. Hong Kong. Their market saw a, frankly, remarkable 21% gain in the first half of the year.
Yeah, and what's truly unique there, I think, is why. That rally was overwhelmingly fueled by money coming in from the mainland.
Despite weak performance in mainland China's own markets.
Exactly, which is really telling. It suggests Hong Kong is viewed as a significantly more stable, maybe more accessible gateway for Chinese capital, perhaps hinting at some deeper investor unease within the mainland itself. It's a really compelling contrast.
So, okay, let's try and synthesize this. What does this kind of complex picture mean for you? It really just underscores how fast the economic winds can shift, doesn't it? Based on trade, geopolitics, domestic policy.
Right.
It creates both opportunities and these, well, deep pockets of uncertainty.
Yeah, if we try to connect it all to the bigger picture, I'd say, look, despite the sort of general improvement in global risk appetite, there are significant underlying cross-currents. particularly around U.S. policy and specific sectors like energy.
So not uniformly optimistic.
Not at all. It's really about navigating a world filled with constant and often contradictory information.
Right. Okay, so here's something for you to mull over then. How might this continued U.S. policy uncertainty keep shaping global investment patterns in the next few months? And maybe more intriguingly, what does that divergent stable oil prices but hedge funds dumping energy stocks, what does that really suggest about market foresight? Something to keep exploring.